The blast didn't erupt in Washington, and it didn't strike Beijing. It detonated quietly, deep inside China's interbank system, unheard on the surface, but powerful enough to ripple through the global order. Morgan Stanley, the fifth largest bank in America, didn't just raise capital. It did something unthinkable. It tapped Chinese money, in Chinese yuan, on Chinese ground, through Chinese platforms that completely sidestepped the US dollar's architecture. No Wall Street clearance, no American gatekeeping. And this wasn't a trial balloon or a hedge against risk. It was a full-scale commitment. $278 million worth of panda bonds, issued in yuan, approved and settled under Beijing's direct supervision. The same regime once branded a currency manipulator by Trump. This isn't speculation anymore. It's open rebellion. Wall Street is peeling away from the dollar, not in shadows, but in plain sight. The timing made the tremor even louder. Just hours before the deal went public, the US Treasury admitted to a colossal mistake. Borrowing for the third quarter didn't merely climb, it surged by $453 billion. Total debt soared to $1.7 trillion. $1 trillion added in only 3 months. Money America needed just to keep the engine running, just to stay afloat. This isn't sloppy bookkeeping, it's systemic decay. The dollar isn't collapsing outright. It's being strategically outflanked by the very players it once dominated. Foreign dollar reserves now stand at 58%, the lowest level since records began in 2001, when the share was 73%. That's not a dip. That's 2 decades of steady rejection. And here's the twist. The retreat isn't being led by adversaries. It's led by allies. The biggest sellers of US Treasuries in 2025 aren't China or Russia. They're Japan, Switzerland, Canada, the closest economic and political partners Washington has. Bloomberg revealed Japan sold off $54 billion in US debt in just 6 months. Switzerland liquidated $22 billion. Norway trimmed $11 billion. This isn't whispered strategy. It's happening out in the open. Meanwhile, as capital drains from America, Beijing is erecting a financial empire, built not with armies, but with credit. Hungary issued a 5-year yuan bond this summer, becoming the first European government to take the plunge. Soon after, South Korea joined, then Poland. Multinationals like Mercedes-Benz, BMW, Volkswagen, and even Canada's National Bank followed suit. They're not just trading with China, they're borrowing directly from it. The panda bond market has erupted, more than doubling in size within a year. In 2025 alone, it raised $15.5 billion, with over half of that funding coming from beyond Asia. The yuan is spreading faster than Washington can explain it away. The reason is brutally simple. Borrowing in the US has turned poisonous. Moody's says average yields for new American corporate bonds now sit above 5.5%. Treasury yields hover around 4.8% and keep rising. Compare that to Morgan Stanley's panda bond, secured in Beijing at 1.98%. That isn't just a discount. That's a completely different financial universe. The core driver? Inflation. But not ordinary inflation, weaponized inflation. The Fed jacked up interest rates to crush price growth, but Trump's tariff war reignited the flames. With duties revived and expanded, the average US tariff rate is now above 13%, the steepest in 90 years. Intended to punish imports, they instead triggered a chain reaction. The Producer Price Index for intermediate goods surged 7.1% year over year. Food inflation is stuck above 5%. Gasoline alone has climbed 5% in 6 months. The economy is suffocating under its own policy choices. And instead of relief, Washington escalated. Trump issued Moscow a 10-day deadline. Make progress on Ukraine peace talks, or face sweeping US sanctions on any nation still purchasing Russian oil. Translation: threaten half the world's energy supply while your own economy is already gasping. The effect was instant. Oil prices spiked. Crude jumped 3.5% in a single day. Brent crude ripped past $72 a barrel. Inflation expectations soared. The bond market cracked. Yields on the 10-year Treasury leapt 14 basis points overnight. The Fed's guidance disintegrated. Jerome Powell now faces an impossible choice: defend the dollar or rescue the economy, but he cannot do both. The White House tried to frame it as calculated leverage. Markets saw desperation. BlackRock strategist Ben Powell put it bluntly: no government threatens trade partners in a fragile supply chain environment unless it has run out of options. And Russia? Russia didn't blink. It doesn't need America's markets anymore. It has India, China, Brazil, the UAE, and even Japan. Reuters confirmed Japanese refiners, despite G7 sanctions, have restarted small-scale Russian crude imports through intermediaries. The quiet flows are already underway. This was never supposed to be the trajectory. But it is. Not with speeches or fireworks, but with steady, deliberate action. And the most unsettling truth? The unraveling isn't coming from America's foes. It's being driven by its allies, those once most loyal to the dollar, walking away in silence from the empire that once commanded the world's wealth. The dollar isn't collapsing in flames. It isn't being toppled in some dramatic coup. It's being sidestepped, quietly, deliberately, efficiently, deal by deal, payment by payment, agreement by agreement. The real question now isn't whether this shift continues, but whether anything can halt it. Beneath the calm surface of global finance, a deep undercurrent is moving. For decades, nearly all international transactions passed through SWIFT, routed in dollars, controlled by Washington's reach. But today that flow is splintering. Money is being rerouted through alternative systems. The Chinese clearing network, bilateral pipelines, regional hubs, where settlements take place not in dollars, but in yuan rupees and local currencies. And once those pipelines are built, they rarely run dry. Take India. For years a quiet participant in the US-led system, careful not to upset the balance. Now it has signed a $45 billion oil pact with Russia, structured entirely outside the Western financial order. No dollars involved, rupees and rubles instead. That isn't rebellion. That's adaptation. America's once unshakable leverage, the ability to dictate financial rules, to weaponize its currency, to control the flow of trade, is eroding. Once absolute, it's now conditional. Once unquestioned, it's becoming dismissible. Because financial supremacy doesn't vanish when trade routes shift. It vanishes when faith in it dissolves. And that faith is unraveling. Look at the US-Japan mega deal. It was announced as a $550 billion victory, a milestone for American leadership. President Trump declared it historic. But Tokyo immediately set the record straight. Japan's Ministry of Economy revealed that less than 2% of the sum, just $11 billion, was genuine investment. The rest? Credit lines, soft loans, complex obligations, much of it still waiting for approval. The White House insisted American firms would capture 90% of the profits. Reality, only a tiny fraction tied to niche projects. Not infrastructure, not energy, nothing truly transformative. Japan delivered the blunt clarification. The United States will not receive $550 billion in cash. So what did Washington really secure? A headline. And what did Japan secure? Political shielding, wider market entry, and a corridor into Mexico. That wasn't economic victory. It was diplomatic leverage. Meanwhile, Washington itself is drowning in red ink. In just 8 months of 2025, the federal deficit swelled by $1.4 trillion. By September, another trillion will need to be borrowed. By year's end, the shortfall will top $2.4 trillion, over 8% of GDP. And here lies the problem. The world is losing interest in funding it. Foreign creditors are retreating. Local investors are wary. The Fed is standing back. Yet the government must keep borrowing, which means interest rates climb, inflation persists, and the foundation of global trust, the dollar, begins to shake. Everyday prices follow. Beef costs 54% more than it did in 2022. Milk is up 23%. Eggs 31%. Rising costs for fuel, fertilizer, and feed are tearing through the supply chain. The only political answer, subsidies. Trump has already promised them, but subsidies require more debt. More debt means more auctions. More auctions push up yields. Higher yields trap the Fed. The system is locked in a feedback loop with no exit, which is why the Morgan Stanley bond mattered. It wasn't just another issuance. It was a signal, a marker from America's own financial establishment. Morgan Stanley chose to borrow in yuan. Not as a hedge, not as an experiment, as a working reality. Because Chinese capital markets offer liquidity that is faster, more predictable, and above all, less political. Wall Street sees it, and it isn't alone. Saudi Arabia's sovereign wealth fund issued its first yuan-denominated sukuk this summer to finance construction projects inside China. In Europe, a Greek firm raised $600 million for yuan-linked investments in cross-border trade. The UAE's central bank opened a direct yuan clearing facility. These choices aren't ideology, they're balance sheet decisions. And once positions are taken, they tend not to reverse. Even India, long cautious, revealed that 8.3% of its foreign reserves are now held in yuan, a record level. This isn't de-dollarization as a threat. It's de-dollarization as practice. As routine. As the default setting of global commerce. In July, the Bank for International Settlements quietly flagged an alarming shift. International transactions in dollar currencies have surged 36% year on year, the steepest rise since the 2008 crisis. Why? Because export-driven nations, Vietnam, the UAE, Brazil, Singapore, are actively managing down their dollar exposure. Meanwhile, China's own interbank payment system has exploded to $430 billion in volume, a 65% jump in a single year. HSBC's Ronald Mann spelled it out. The yuan is no longer a hedge, it's infrastructure. Even agriculture, once dominated by the dollar, is flipping. Brazil is now selling soybeans to China priced directly in yuan. Its central bank confirmed the consequence. Yuan reserves have overtaken euro reserves for the first time. This is no longer diversification. This is fragmentation. A world quietly constructing a backup plan. Patiently. Systematically. In full view. And yet, Washington's rhetoric hasn't evolved. Officials still behave as though the dollar is untouchable. As though allies can be threatened, adversaries punished, and consumers burdened without consequence. But every time the US flexes its old tools, sanctions, swift cutoffs, currency pressure, it accelerates the very alternatives designed to bypass it. And those alternatives, once built, don't vanish. They harden into permanence. That is why the Morgan Stanley bond cannot be dismissed. It required no blessing from the Fed, no oversight from Treasury, no permission from policymakers. It simply happened. Clean, quiet, complete. One major American bank raised money in yuan. And that act poses the question Washington refuses to face. What happens when the rest of Wall Street follows? Because when your own financial core begins to trust a rival's currency more than your own, it isn't just a warning. It's the opening move of surrender.